Markets are pricing in a no recession soft landing. We think there is a good chance of a soft landing, but the delays to central bank rate cuts means that there is still the risk of a harder landing later in the year or in early 2025. Hi, I'm Andrew Pease and I'm the Chief Investment Strategist for Russell Investments. Welcome to the third quarter update of our 2024 Global Market Outlook. There is still no clear answer to this year's key question. Is the United States economy heading towards a no, soft, or hard landing? We think that a no landing, where the economy reaccelerates and inflation rises, is the least likely outcome, and that the signs of slowdown in the economic data mean the debate is now mostly between a soft landing or a recession. Financial markets are backing the soft landing scenario. This is evident in the optimism around earnings growth expectations and in high-yield credit spreads that are pricing cyclically low levels of defaults. Soft landings are rare after big Fed tightenings, and the argument for getting one this time is that because of COVID and the lockdowns, this cycle is so different that the normal rules don't apply. The case for a recession is that the old rules will eventually apply, but it's just taking longer this time. The US economy has never previously avoided recession after such a sustained period of restrictive monetary policy. In fact, the resilience of the economy potentially makes a hard landing more likely by delaying the timing of Fed rate cuts. Although we think that a soft landing is possible, we worry that markets are underappreciating the risk of a mild recession. This creates an asymmetry in the return outlook. There is some return upside if soft landing expectations are correct, but a potentially significant drawdown if a recession happens. We're seeing better economic conditions in most other developed economies as they catch up from relatively lackluster post-COVID economic growth outcomes. Europe is being boosted by the upturn in global manufacturing and a resurgence in bank lending growth. Japan is also getting support from stronger global manufacturing and is being helped by the weak yen. The United Kingdom is finally seeing some better growth indicators, but persistent inflation is delaying Bank of England rate cuts. The China outlook is also brightening as a result of policies to stabilize the property market and boost the economy. China faces longer-term structural issues related to high savings, low consumption, overcapacity, and a reliance on export demand. The policy moves, however, have boosted the near-term outlook and have helped Chinese shares bounce from deeply oversold levels earlier in the year. Let's turn to our asset class outlook. We assess the market outlook through our cycle, valuation, and sentiment investment decision-making framework. The soft versus hard landing debate means the cycle remains uncertain and valuations for risky assets such as equities and corporate credit are expensive. Government bonds, however, are attractively priced across most developed markets. Finally, our investor sentiment indicator shows that market psychology is optimistic but not at an extreme of euphoria that would warrant a strong risk-off stance in our portfolio strategies. We're not currently seeing strong tactical opportunities across equity regions, sectors, or styles. The value factor, small caps, financials, and emerging markets offer good value, but the return asymmetry means our equity strategies are generally neutral and emphasize stock selection as the main driver of risk and return in portfolios. The expected decline in borrowing costs from central bank rate cuts should be a tailwind for listed real estate due to its interest rate sensitivity. We're neutral on most major currencies, with the greenback looking expensive and the yen particularly cheap on a purchasing power parity basis. We like the yields offered by private credit, although picking the right manager is critical. Within real assets, we expect commercial real estate values to bottom out in 2024, and we think that the sustainable energy transition should continue to support demand for base metals. This year has become a three-scenario problem for investors. We think the no landing scenario is unlikely, the soft landing outcome is possible, and the hard landing or recession is more likely than priced by investors. We think the soft landing expectations can persist as inflation expectations decline. However, the asymmetry in the return outlook means we'll be watching closely for signs of a deeper downturn. Thanks for watching. Please take a closer look at the full report, and we'll talk to you again soon.